Hi, everyone. This is Jason Burek of Wall Street for Main Street. We have Ron Hera of Hera Research back, and he's going to discuss his new article, which has to do with prolonging this system, this monetary system and this world economy, which is based on Ponzi finance and massive government deficits and debt-based fiat money. So, Ron, why do you think prolonging the system, what are the ramifications for prolonging the system, and lay out for our listeners your argument in your new article?
Well, thanks for having me on again, Jason. I guess the first thing is that, since 2008, we've had a lot of analysts, and, there's even some math behind this, arguing that we're looking at some type of hyperinflationary collapse of the U.S. dollar. And to some extent, this type of analysis underestimates the ability of central banks and governments to prolong the current system. And I mean the U.S. dollar as the world reserve currency, as well as the financial system, literally, by bailing out banks, continuing to monetize assets of banks, such as mortgage-backed securities or sovereign bonds, and at the same time, the ability to manage the currency rates, exchange rates, even though you have overall declines in the value of money, which, of course, that's unavoidable if you're creating new currency units, so to speak. But they're able to manage exchange rates and, to some degree, stabilize world trade, albeit at a lower level compared with the pre-crisis period. So given that that's the situation, the question is, well, how long can they keep this up? So you have this sort of, Herb Stein argument on one hand is that, things that can't go on must stop. And then on the other hand, you have this situation where, well, as long as they continue to bail out banks and, buy assets from the banks, basically hand them cash at 0% interest, et cetera, and as long as they control sovereign bond yields, as long as they are willing to continue to lend money to these governments, like in Europe, and or even just give them money in bailouts to monetize debt, like the Fed buying U.S. Treasuries. I don't just mean to manipulate Treasury yields, but literally just funding the government through money printing. That situation actually can go on, I would say, for an indefinite period. I don't mean forever exactly, but for the foreseeable future, certainly it can continue, just as it has for the last 4 years. So the question, and I would say the interesting question is, well, what does the world look like? So if you go back to the 1971 crisis, where you have the dollar decoupled from gold, finally Nixon closing the gold window and decoupling gold from the dollar and removing the last vestiges of the gold standard and the Bretton Woods Agreement. From that point, there were many critics saying that the dollar was set to collapse. But 4 decades later, essentially, that has not happened. And once again, in 2008, we have a global financial crisis, which wasn't specifically a dollar crisis, but of course the current situation is a financial, a currency crisis, and it's been characterized by Jim Rickards as a currency war. So the question is, if this is prolonged, let's say for a decade or more, 2 decades, 3 decades even, what does the world look like in that situation where governments are funded by money printing and where banks essentially enjoy a sort of indemnification? I mean, they're too big to fail. It doesn't matter how much risk they take, they're going to be bailed out. So, you can almost call it a sort of a bankocracy where, the banks are by far the most powerful, influential companies in the world, and what they do has more influence over the lives of everyday people than governments. And so what does this world look like 20 years on?
Well, before I throw in my 2 cents about what's going on now and what I see in the future, I'll go back to the 1970s and 80s and what my interpretation is of the financial history. And yes, the people in the 70s, they were right that gold was going to go up starting in 1968. You had Jacques Rueff, who wrote Monetary Sins of the West. And, France started exchanging their Federal Reserve notes or gold, whatever it was, for gold back then. And, you had a lot of the other trade partners with the U.S. start exchanging. But the U.S. at that time was so far ahead of every other country in terms of trade surplus. We were still a creditor nation then, even though we were running the massive welfare warfare state with LBJ and the guns and butter programs. So, and then we had a Fed chairman come in, in Paul Volcker, who actually did the right thing. So that's what bought us the time. I think, if we didn't have the Volcker and the collapse and reset, which was a pretty bad recession for 4 or 5 years during the 80s, then you wouldn't have had the trust restored. And that 4 or 5 year recession and that protecting the dollar was what allowed the U.S. to get back to doing really stupid things with their monetary and fiscal policy then, and running up things for another 15 or 20 years, and that's what prolonged the system, in my opinion.
Yeah, I completely agree. So first of all, there are many differences between now and 1971. I don't mean to make an analogy. I only was pointing out that was a point in time at which the dollar was in crisis, and there were many analysts who believed that the dollar would collapse. But it took another 40 years to reach the point of a global crisis. In the meantime, the dollar continued to expand. In fact, if you look at the TMS, the true money supply, it expanded at an exponential rate, and it still is essentially expanding. And on that long-term graph, it looks like a vertical increase at this point in time. But there were many differences. I mean, right now, the dollar is essentially supported by central bank interventions, by the petrodollar standard, and indirectly by the U.S. military. And so, if you look at the probability or the different ways that the dollar could collapse, I really see 3 different scenarios where that could happen. And there's really one of them I think is the most one of them is inexorable. I mean, it's coming one way or another, and that's the government finances. Another one I think is the most interesting, and in the long run, the most crucial, especially if the world tolerates more money printing, which would prolong the U.S. government's financial situation, which of course is untenable in many ways if you consider the unfunded liabilities. But the 3 scenarios are basically that you've got a potential domestic collapse of confidence, a sort of rush out of dollars, or a breach of trust with the banking system. People go to the bank, try to get their money out. Everyone starts using cash. They won't trust the banking system. So that's a situation that we've seen in other countries where there's been hyperinflation, and particularly in Germany. This is what we saw in the Weimar situation, is a lack of trust in the banking system and unwillingness, largely because of inflation, to use the banking system. And so you saw increased demand for cash, and then prices being bid up for real things, and a rush ultimately out of the currency, resulting in the skyrocketing hyperinflation. So, I mean, there's other aspects of hyperinflation and sort of other scenarios that have played out in history, but basically, let's just focus on that one, because I think that's the main thing, where you have a lack of trust in the banking system and a rush out of the currency on a domestic basis. So that's one way that hyperinflation could happen. Another way that hyperinflation could happen is if the U.S. government finances break down and it becomes impossible for the government to borrow money. In other words, the treasury auctions fail. And at that point, confidence in the government finances and in the currency, in U.S. dollar-denominated assets, especially treasuries, obviously, would fail on an international basis, and the currency value could potentially plummet, resulting in hyperinflation, a rush out of the currency even on a global basis. And then finally, there's a way that hyperinflation could happen where there's a rejection of the currency on an international basis, regardless of government finances, although a breakdown of government finances would certainly cause rejection of the currency on an international basis. And then rejection of the currency on an international basis, needless to say, could cause a domestic collapse of confidence in the dollar, et cetera. But setting aside the links between, because you can have different causal links if any one of the 3 scenarios materialized. But in this last scenario, you have a rejection of the currency on an international basis, and that's the one I think that's by far the least likely. And I mean least likely that it would happen suddenly and in a catastrophic way, because it is happening. The dollar is being rejected more, systematically rejected in international trade. But if you project that out in terms of the rate at which it's occurring, and it has accelerated, and consider some of the other factors, like the fact that we still have the crude oil traded in dollars, and we still have the world's dominant military. The world, the U.S. is the world's sole superpower. So given that that's the case, and given the fact that nations and corporations and central banks around the world have a vested interest in the U.S. dollar system, if you will, it's unlikely that there would be a complete collapse of the dollar based on a rejection of the dollar internationally. You have reduced use of the dollar internationally, and you can project that forward linearly. And even if you suppose that it accelerates, that in itself will not, in the foreseeable future, certainly will not cause a hyperinflationary collapse of the dollar. There are just too many vested interests involved. Even our enemies, enemies of the United States, will not rush out of the dollar, will not dump their U.S. Treasury holdings in a sudden way in order to bring about a catastrophic collapse of the dollar system. So that's the least likely scenario. The government finance scenario is one where basically the government has already passed the point. The U.S. federal government has passed the point where any combination of taxes or budget cuts will allow it to manage its debt, to pay off its debt, and also meet its unfunded liabilities for Social Security and Medicare. Those numbers are in excess of $60 trillion on top of the $16 trillion public debt. So there is no way that that's going to work out mathematically unless the dollar is greatly devalued. And currently the Fed is systematically devaluing the U.S. dollar, and that's the path forward, they believe, policymakers, is to inflate your way out of debt. And, that is going to have there's a lot of implications around this sort of continuous inflation, which is part of this scenario that we're talking about. And then on the domestic side, so in terms of government finance collapse, the world has already tolerated a great deal of money printing and 0% interest rates. It's gone on for 4 years, and we've passed, the point of no return passed a long time ago, even before the 2008 crisis, in terms of the government paying off its debt and also meeting its unfunded liabilities. So there's no reason to suppose that the tolerance for this sort of, farcical finance is going to evaporate suddenly. It may break down in the future, certainly as the situation becomes worse, maybe around 2016 or 2020. But even though you could see that as a sort of increasing probability of hyperinflation based on collapse of U.S. government finance, certainly in the foreseeable future, this year or next year, there certainly isn't any reason why the dollar system can't go on just as it has for the past 4 years. Or even before if you look at the unfunded liabilities. So now if you come back to the domestic hyperinflation situation, where this idea that there could be a rush out of the currency and a breakdown in the banking system, in a way this is the least likely in one sense, but also the probably the most serious problem lies there in domestic confidence. And what I mean by that is that, first of all, you don't have a lot of cash. People don't have a lot of savings today. So, the idea that people would reject the banking system is really not that credible if you consider that people have automatic payroll deposit and people use debit and credit cards all the time. People don't have a lot of savings. They don't use a lot of cash. So, it's not like Weimar Germany. It's not like people will not trust the retail bank, which has the FDIC standing behind it. Now, of course, you can argue that, well, if all the banks failed, then the FDIC wouldn't be able to backstop all of them, but they're not all going to fail. That simply isn't the case.
And if I could chime in here too, most of those Americans, the same ones you said that don't have savings, a lot of them who are working 2 or 3 part-time jobs and living paycheck to paycheck, they have also gone to business school or studied economics, and they've learned Keynesian economics, and they don't see any other perspective other than what they're taught in school. They fully believe everything in the textbooks, and they see this as a liquidity trap that Bernanke and the others can follow. I've argued with a ton of very bright people with top degrees from top universities, people who have worked on Wall Street, and they literally, a lot of them don't have any critical thinking, to be honest, and they just repeat whatever their professor said or whatever their textbook said, that this is a liquidity trap and that the central bank and government needs to be allowed to do whatever they need to do.
Yeah, that's an interesting point, and I think it's true to a large extent that you're dealing with a population that really doesn't understand money, essentially. They don't understand finances. Now, the argument here would be that high inflation, escalating inflation, could cause this sort of, collapse of confidence and a rush out of the currency on a domestic basis. And, in my view, it's unlikely that that this would occur in the way that it has in the past, because of the factors that I mentioned, that people just don't have any other options. And if you look at, let's say, Zimbabwe, for example, or Yugoslavia, or even in the former Soviet socialist republics after the collapse of the Soviet Union, there always were alternative currencies of one kind or another, especially the dollar. If you look at, let's say, Argentina, for example. So, U.S. citizens don't have any other currency. So the idea here is that, look, if you look at some of these other recent collapses, you had high inflation for a long time, for years. And we're nowhere near in the United States those kinds of levels. In other words, we have officially 2% inflation roughly, and then unofficially, if you measure it back in the way that it was before in the 80s, before they changed the methodology for CPI, the consumer price index, then we're closer to 8% or even 9% inflation right now. Well, if you look at cases of hyperinflation, that kind of inflation was tolerated, like especially in the Argentinian currency crisis, or even now in places like Lithuania. I mean, you have people facing 10, 20, 25% inflation year after year after year. There isn't a collapse. So, I question this idea. Now, if inflation escalates, if at an increasing rate, then you have a different situation at that point. But certainly, the fact of inflation, even high inflation, will not cause a hyperinflationary collapse of the dollar because of domestic loss of confidence in the dollar. So I really question that premise. However, this sort of brings us to the point I made earlier about, well, why is this idea of domestic confidence important, and why did I say that's the most serious, ultimately, issue, even more serious in the near term than the government finances, federal government finances. And the issue here has to do with recklessness and criminality, and the fact that you have these limitless bank bailouts. You sort of have this moral hazard going on here, where financial crime and scandal is the new normal. And if you go just through the whole list, I mean, whether you're talking about LIBOR, which involved J.P. Morgan and Citicorp allegedly, if you talk about HSBC laundering money for the Zetas and for states that sponsor terrorism, or the J.P. Morgan's London whale loss, or the failure of PFG Best and 200 million in, plus customer funds disappearing, or MF Global 1.6 billion in customer funds that are still substantially unaccounted for. So these kinds of scandals and certainly unethical, if not criminal behavior. This is a new element that was not present if you look at historical instances of hyperinflation. And what I mean is that there's a question here about the legitimacy of the U.S. financial system. So it's not a question of confidence in the bank or in the government. In this case, there's a new question. So if you want to say, well, how could hyperinflation happen in the dollar system today? And, we look at it as a world reserve currency. That's an unprecedented scenario where you've never had a world currency go in hyperinflation. You can look at it from the point of view of the government finances and say, well, the government's finances might collapse and cause the dollar to go into hyperinflation. Well, except that the government finances are already somewhat farcical, and you haven't had a collapse. And so for the foreseeable future, given the power of central banks and the ability of the vested interest that everyone has in the dollar, everyone being central banks and governments and big corporations around the world, and that's kind of you can relegate it to the unlikely category for the foreseeable future. And then in terms of domestic hyperinflation, you don't have an old-fashioned collapse, if you will, like a run on the bank kind of collapse, where people say go to the bank and go get all their cash out of the bank. That's not what we're looking at. What we're looking at is a collapse in confidence in the financial system because it lacks legitimacy, the perceived legitimacy of the financial system. In other words, if the average person considers the financial system to be a criminal enterprise, then what you're looking at is not a collapse of retail banking, not a run on the bank per se, but a run on the financial markets, a run on 401ks and IRAs, a run on stocks, people taking their money out of the market. I think that's already happening. And I think, we've seen this sort of breach of trust and a lack of protection for retail investors in the commodities side of it with MF Global, and we've seen a lot of other unethical, if not criminal, behavior. It could be called a crime wave, and certainly since we've had this too big to fail policy, that's escalated and is continuing by all evidence to escalate. I mean, whether you're talking about subprime mortgage or foreclosure fraud, or now there's numerous civil and criminal cases in the court systems, and this problem is growing. It's not shrinking, and so that could actually cause a failure of confidence in the U.S. financial system, and I'm talking about in stocks, in bonds, in brokerages, in investment banks, and this is a serious issue. That is a new threat to the dollar system. It's a new potential cause of hyperinflation that is arguably more serious, and I am arguing that it is more serious than the government finances.
You've laid out a very, very long argument, and it's pretty convincing. And I would also add that at this stage, I mean, the retail investor, to a lot of extent, has become very relevant when the central banks can literally just print up the money. They can take the bad assets right off the bank balance sheet, the large bank balance sheet for Wall Street and the investment banks and Bank of America, et cetera, and just hand them new capital, and then they could go buy dividend stocks. Those guys can also go buy whole tracts of houses here in the U.S., which a lot of the shadow inventory, I don't know if you've been following this, but a lot of the shadow inventory in the U.S. has been bought up by foreigners like the Saudis, the Chinese, and hedge funds who have just been able to borrow literally at zero, or they get fresh money from the Fed, and then they come in and buy it up for almost nothing.
Well, yeah, and that's another facet of it, especially when we talk about the government finances and in terms of how to prolong the system. So both from the bank's perspective and also in terms of government finances, what we're looking at is a situation where the Fed or the ECB, through various channels, can create money, whether they're loaning it or whether they're buying assets direct in the market, direct from the Treasury, direct from banks. They can create money through multiple channels and basically keep the banks solvent and fund the governments, and you're not going to see the kind of market reaction that you might think. So in other words, if it was a single channel, just an isolated event where the ECB decides, okay, we're just going to print money and we're going to buy Spanish debt, and we're going to buy Irish debt, we're going to buy Greek debt, that's inflationary, and it tells you that it weakens the currency. It tells you the euro is being cheapened, and that this reckless, irresponsible financial planning is going to be tolerated. And that if that was the only problem that existed in the world, then you'd have steady pressure on the euro. But it's a multi-channel scenario, and it's a scenario where all the major currencies, the pound, the euro, the yen, the dollar, they all face the same situation. And because of the priority for international trade to maintain trade, stable trade, you see other currencies debasing too. So they have to buy up the excess dollars and the yen and all that other stuff that's created. So effectively, they're importing all the inflation that the West create, allowing the West to do even worse behavior. Yep, choice. So whether you're talking about the RMB or the Swiss franc or the Swedish krona, you really have the same situation where all the currencies are being synchronously debased. Eric Sprott has characterized this as bonfire of the currencies. Jim Sinclair coined the term QE to infinity. That's the scenario that we're in. And so the real question here, as I pointed out at the beginning, is what does the world look like? What I'm saying is that this isn't a collapse per se. I mean, it's the collapse of an old paradigm, right? It's a collapse of the expansion of the dollar system and globalization of the economy.
It's also, in my opinion, too, Ron, a collapse of what used to be conventional capitalism, because they never would have been able to get away with it. The people would have had the financial understanding, the economic understanding to know what was going wrong, and they would have demanded that this stopped, or the bond market would have revolted. But now the Fed, essentially with the primary dealers on Wall Street, they control the bond market, so they don't even have to worry about bond vigilantes essentially for a long time because they have the bond vigilantes, bought and paid for with the primary dealers.
Yeah, that's exactly right, and that really brings us to the heart of the matter. So, we talked about this issue about collapse of confidence because of the legitimacy of the financial system, and that being a risk to the dollar and to the U.S. economy. That's one big piece of this analysis. The other big piece of it, and really the upshot of it, is that, look, if you're in this scenario where you have for the foreseeable future, potentially for a decade or 2 decades or indefinitely, we don't know how long, a situation where this moral hazard exists and where this money printing continues, what we're talking about is a collapse of traditional capitalism and the emergence of what you could call a new economic paradigm. A new economic paradigm that essentially is a kind of financial totalitarianism, because the average person cannot save. You have the destruction of savings because of inflation and money printing, and so
it's serfdom.
Right. Well, that's one way of characterizing it. Yes, it is a kind of serfdom, and so what you have is the complete and total replacement of capital with credit, because there is no savings, and so that.
But credit is so dangerous, though.
Well, yeah. I mean, the servicing debt. I mean, there's a lot of issues there, but I think, to me, the most significant implication of this is that if you destroy savings systematically on a global basis, what's happening in that situation is you're destroying the engine of small business creation. Basically, what's happening is that small business creation is being stamped out, because that is driven by savings in the hands of the middle class.
And savings is also freedom, too. If you have savings, you don't have to work a job you hate. You can go travel. You have the options to invest in multiple businesses. So, without savings, you don't have as many options.
Right, that's true. I mean, if you look at it from the point of view of an individual worker, whether they're, even a doctor or a lawyer, a so-called professional, that's now a person who, can work and maintain their lifestyle, but they're not going to be able to accumulate wealth over time because savings will be systematically destroyed. Now, the implication of this is that without small business creation, right? I mean, Bernanke said when he announced QE3 that he was concerned about jobs in America, right? Well,
yeah, I don't believe him.
Well, whether he's sincere or not, the fact is that QE3 is going to destroy jobs. And, whether he believes that it will create jobs or not. See, he thinks, and the policy basis here is that, and this is not just Bernanke, I mean, this is part of the whole, Keynesian economic paradigm. They think that small business creation is driven by bank credit. Right, and that if you want to start a small business, you go to the bank and take out a loan. But if you didn't have any savings and you didn't have any capital originally, I'm speaking of the just a typical middle class person who might think about starting a small business, right? Then you can't get a loan from the bank, right? And furthermore, if you didn't have any money at all, you're just paying the bills paycheck to paycheck, you're not going to be thinking about starting a new business. So the only way small businesses are created is ultimately through savings, and I'm talking about creation, not funding operations, not funding payroll. I'm not
savings and risk taking. Yeah,
I'm not talking about borrowing money to expand your small business. So there's a big breakdown, a big disconnect, a real mistake in the policy. And the mistake in the policy is the assumption that bank credit doesn't just fund operations and expansion of small businesses, but that bank credit is the engine of small business creation, and that's false. That's wrong. It is not the case. It's the exact opposite. Savings is the creation, the engine of small business creation, and without savings, you don't have small business creation. It's not going to exist. Small businesses are being systematically stamped out by these policies. Jobs are being destroyed by these policies. QE3 is destroying jobs right now. And in the future,
it's destroying the private sector. Yeah, it's destroying the whole private sector except for the large corporations and the special interest groups and the crony capitalists that are connected to the Fed or the Wall Street banks, or they have, the government agencies like the Department of Energy or others in their back pocket.
Yeah, exactly. So what you have now, projecting this forward, say 10 or 20 years, is you have a growing let's just be, politically correct here and say you have a growing surplus labor pool, right? You have all these former middle-class people who are now poor.
And a growing world population, too, on top of that.
And the problem's not isolated to the United States, right? So you don't have traditional capitalism, you don't have small business creation, you don't have, the major source of jobs is greatly reduced. And in terms of small businesses, you have a continued expansion of large multinational corporations. But now the problem you have is unemployment, right? I mean, it's a structural problem that's
you have inflation and unemployment. You have the worst of both worlds. You have you're strengthening my stagflation argument, Ron. You're doing it for me. You have a higher unemployment, like I said. You've laid out the case, and then you have higher prices going forward too on all the consumer staples, food, energy, etc.
Yeah, I completely agree that stagflation is what we have right now, and in fact, we've had it for for the last couple of years, and I've said so.
And it's only going to get worse.
But the real issue here for Western countries is the problem of unemployment. What do you do with all the surplus workers, right? Because you have these policies that are for the benefit of the big banks, for the benefit of the government, for the the benefit of multinational corporations, for the benefit of the U.S. dollar system, strategically in the interest of the United States, so to speak. And now, let's just look at the United States for a moment. What do you do? I mean, so there's a calculation that I have. I call it the extra people calculation. So you take the number of people that are unemployed based on U6 or John Williams numbers, the way that unemployment had been measured, and you look at right now it's about 21%, I think, or just look at the EM ratio, which is the Federal Reserve's own data. And it tells you how many people are, quote-unquote, in the workforce, and you can see over time how many people have fallen out of the workforce. So that, in fact, there's a chart in the article we were talking about. And so you look at those data and you say, okay, how many people don't have a job? And officially I think we've lost under U6 something like 8 million jobs or something. The real number is probably much higher than that. And, if you just go with a number, let's say 15 million jobs have been destroyed. And now you do a calculation and say, well, the average household size is 2.5 persons, and some percentage of those people who lost their job were sole wage earners. And so you can actually come up with a number, which I think is around 50 million people right now, that actually have no financial means of support. So you have a country with 308 million people approximately, and you've got more than 10% of those people who have no financial means of support. They have fallen out of the system. They've fallen through the cracks. These are now surplus people. And, if you look at food stamps and other data, I mean, that's very consistent with what I'm saying in terms of what those numbers look like, in terms of the number of people in the United States right now who are not part of the system. They have fallen out of the system. And what's important is that there is no opportunity. They have been thrown off the train. They can't get back on. There aren't any jobs for those people. They're gone.
Yeah, and they're going to have to figure out how to add skills without savings, which is even worse. And part of those statistics, before we I talk more about the statistics, I want to talk about John Williams. John Williams does a great job because he used to work for the Bureau of Labor Statistics at Shadow. Now he works for Shadow Stats, for listeners who are not familiar with him. And if you were in Argentina, if John Williams opened up his shop in Argentina and put these honest formulas and calculations, showing the real GDP and the real unemployment, in Argentina, that is against the law. That is a felony. He would be in prison for doing what he's doing now, for going against the government calculations. So I think the level of propaganda, which is very, very high in Argentina, it's like 30% real inflation rate, but the official government statistics are only like 9 or 10. I think that's the type of propaganda path the U.S. is going to have to be headed down. And yes, more people are going to wake up, but it's going to be very, very slow still. And unfortunately, I think we're going to be stuck in worsening stagflation.
I completely agree with all of that. And, what's interesting to me is, some people, I've discussed a lot of these issues in analysis and a vast amount of data with many, many people. And a lot of people, when they hear me talk about, well, what is this new economic paradigm and, what does the world look like after 20 more years of this? What does the United States look like after 20 more years of this? What do we do with 70 million extra people people, so to speak, that have just completely fallen out of the system. They have no means of financial support and no economic prospects for the future, no savings, no chance of education, really.
Many of them are going to leave the country probably, right?
Yeah, and so people have said various things, but the thing that keeps coming up is the idea that, well, people just won't tolerate this. That there'll be some sort of, political upheaval, there'll be fundamental reform, there'll be a revolution in this country. I've heard those words again and again. There'll be a revolution in this country if, right? And I have to say that I completely and totally disagree with all of those arguments, because they presuppose that a substantial percentage of the population actually understands what we're talking about today and is willing to take action, and that they can get other people to rally to their banner. And I don't believe that's true. I think that the vast majority of people in the United States of America are much more concerned about, first of all, they generally believe what's in the mainstream news media and are generally unaware of what's in the financial news media. And second of all, they're generally more concerned with entertainment or with the business as usual sort of politics that we're presented with. And so I really don't believe that there's any chance of a so-called revolution in this country.
Exactly, and I agree with that. And I think with small business, to get back to job growth, if we were going to solve things besides fixing the Fed, not allowing them to inflate, and getting back to sound money, we need to get rid of all these rules, all these regulations, all this red tape. We were discussing intellectual property earlier. These are all hurdles, tremendous hurdles, and it's hard enough being an entrepreneur to begin with, having capital and taking risk. There's always, the odds of screwing it up and blowing up the business, even then without all these rules, regulations, and hurdles. But when you add, $20,000, $30,000 in licensing fees, all these other things, the odds of success drop to almost zero.
Yeah, it's this new economic paradigm that I'm talking about is a new kind of totalitarianism. It's a new kind of totalitarianism. You might want to coin the phrase bankocracy or something like this, where it's a sort of financial tyranny, right? There's really no chance for the individual vis-a-vis the banks supported by the central banks and vis-a-vis the government. Right, so the big forces really are the monetization of debt, the managing of financial markets by the central bank and by the primary dealers, in other words, the too big to fail banks, the unlimited backstop for those institutions, regardless of what they do, no matter how risky how much risk they take, no matter how much leverage they have, they always have this sort of, even the word Bernanke put is too mild of a term at this point. They have a virtual guarantee that they cannot fail.
And so do the municipalities too. No.
Well, yeah. So, and then of course you've got the government, which is now, if you consider government at all levels in the United States as an example, it's 40% of GDP. So it's really crowding out the private sector. This is a long-standing argument, but there's no question that with unlimited monetization of debt, that is going to, the government is, and the social the problems in the structure of the workforce, the things we mentioned earlier, where this sort of social welfare programs like food stamps and so forth, that these are set to continue to expand, and that from a political and social standpoint, given that the problems, regardless of what Bernanke says, the problems are structural, especially unemployment, that you won't have the government shrink anytime soon. It's not in the foreseeable future. And my argument, and by the way, I agree with all of John Williams' reasoning and data. However, I don't agree with this conclusion about hyperinflation in terms of timing, because I think the world's tolerance for these abuses is much, much higher than he believes. He actually presupposes that the U.S. Treasury market, for example, is basically a real market, and that foreign lenders and foreign banks, and domestic banks for that matter, will ultimately demand higher bond yields and reject the treasuries, and that you'll have increasing Treasury auction failures. Well, I've analyzed the U.S. Treasury auctions, and I analyzed them after the 2008 crisis, during the peak of the crisis. And I can tell you that there was no sign of Treasury auction distress in the data. And what I concluded was that, actually you will never see a sign of distress in the data. And the reason,
because it's manipulated?
Well, I'm not going to use the word manipulation, but the central banks and the primary dealers of the central banks stand ready to pick up any additional treasuries that are out there. So it's just not the case that you're going to see the market deciding that bond yields. I mean, it's been said the market is bigger than the Fed, right? But is the market bigger than all the central banks and all the governments of the world? I mean, that's the contest, right? I mean, it's between markets and manipulation, or let's call it intervention, right? I mean, what you've got, this new paradigm that we're talking about, this sort of financial totalitarianism, whatever you want to call it, this is basically based on policies and interventions in the marketplace, right? Where you don't have real interest rates, you have policy interest rates. You don't have real bond yields, you have policy bond yields. You don't have real gains in your stocks, you have policy gains in your stocks. So, this is where policies have replaced market forces. And the argument that, well, the market's bigger than the Fed, yeah, it is, except that the Fed is controlling these markets, at least for the time being. Now, I've argued in the past that it's an illusion of control, and that it could break down and the situation could spin out of control. And I believe that that's actually still possible. But it hasn't happened so far after 4 years. So we have to really consider what the world looks like after another 4 years, another 8 years, after 12 years or 20 years of this new paradigm.
Yeah, there's just no money velocity right now, so we could be stuck in stagflation for a while. Now, John Williams, as part of his 2015 argument, it has to do with servicing the interest payments on the debt. So even if the Fed can keep rates this low or drive them even lower, the question then becomes, when can the U.S. government no longer even make the interest payments on the debt? So I think between 2015 and 2017, that number starts to become a little dicey, whether the U.S. government can even pay off the tiny interest payments on the total national debt. So I think that's what John Williams has. But in terms of the money velocity, I mean, there's just no money velocity yet either, because almost all the U.S.'s foreign creditors, everyone on dollar pegs, is soaking up all the inflation that the U.S. with the Federal Reserve and the ECB, all these guys are going to be creating now.
Well, yeah, that's right. And so, the thing is that the finances of the U.S. federal government are already arguably farcical. And so when I use the term farcical finance, right, what I mean is that in a free market, you just wouldn't have these kinds of outcomes. You wouldn't have treasury auctions going off flawlessly again and again and again. You wouldn't have bond yields pegged at less than 2% for the 10-year. I think it's 1.9%. Which is preposterous. It's preposterous. I mean, it's equal to the official inflation rate, which is, in other words, you're investing in treasuries to get your money back after 10 years, not because you think you're going to have any kind of profit. And if anybody thinks that they're going to have a real gain with a 2% yield, when the official inflation is 2%, then of course that's crazy. So it's not a real market. That's my point here. It's that interventions
and what normally would respond, to all of this printing too, besides the bond yields going up, is gold and silver. And when the QE3 was announced, you had a little bit, a $40 move in the gold price is nothing.
Well, QE3. I mean, first of all, QE3 is a different structure from QE2. The money is basically being directed directly into banks and not into the open market per se. And so that, idea of buying mortgage-backed securities, I think Bernanke wants to moderate the flows of this capital. In other words, in QE2, we had money flowing directly into speculation. We had, bond yields go down. We had the stocks go up. We had global commodities, basically spiking. And so that was very destabilizing. I mean, the problem with all this money creation, and this is an unsolved problem that could destabilize the entire system, is that there's no way to control the flow of capital, right? So they can create the money and inject it into the markets, but they can't control where it goes. So it flows into foreign markets, stock markets, into currencies. It's very destabilizing.
Well, other countries, though, are starting to put in capital controls, right? So I think that's where we're headed towards, to stop those hot money capital flows, like you said.
Yeah, well, that's part of the currency wars, and that's another factor, I think, in the structure of QE3, where it's structured in a way where a lot of that money is going to stay in the banking system for the foreseeable future. In other words, it'll be more contained, and the Fed can control that to some degree by manipulating the capital requirements, the reserve ratios of banks. So I think that's the idea, is that he's going to improve the balance sheets of banks improve their ability to lend into the economy, which I don't believe is really going to happen for the reasons we discussed earlier in terms of small business creation. But at the same time, to reduce the hot money flows, as you say, into other assets and into other markets. So that's the idea. And so when you talk about gold and silver prices, there's a thought process. Well, QE3 was announced, and therefore, gold and silver are going to shoot the moon. Of course, you hear that all the time. But the point being that, well, look, the rate at which QE3 is taking place is the same as the rate at which QE2 took place. And after, I don't remember, a year and a half of QE2 or whatever it was, you had a $600 billion injected in the market, but it wasn't injected all at once. It was injected over a period of months. And that's the same situation you have here, where, QE3, the mere announcement of it isn't enough to move the dial on price. I mean, certainly that'll cause a reaction in the market, but that's all it is. It's a reaction. It's not a real debasement of the currency. That hasn't occurred yet.
Well, I'm of the opinion that the monetary inflation has already been created. It just hasn't gone throughout the economy, evenly yet. So there's a lot of money flowing around. A lot of it's already in the derivatives market, so it's not affecting the real economy quite as much as it could. But a lot of the money after 1971, when the dollar was no longer backed by gold, and the money went into derivatives, and they could create all these derivatives. That's where a lot of the inflation, there was a massive amount of inflation since 71. That's where a lot of it has been hidden, is in the over-the-counter derivatives market.
Well, I mean, the notional values of those derivatives are not actual dollar numbers. I mean, those are, those are only supposed amounts that these things represent or that they insure against and so forth. The net value, I mean, this is actually mentioned in the article in passing. The net value of those derivatives would, represents the actual credit exposure. So yeah, I mean, I agree with you that, a lot of cash has been diverted into these markets. But a lot of it is also just sitting around, like at the Fed, for example. So, I mean, it's not the case that all of those derivatives represent money per se. That's not the case. But they do represent some risk and liability for the banks.
Okay, and we're gonna start wrapping things up here on this thing ran along. It was a really good discussion. Wow, you just blew me away about how much you talk. You talked for like 15, 20 minutes straight about your article. Ladies and gentlemen, Ron is worth every penny of his newsletter. He knows things forward, backwards, and sideways, and he does this type of work too on research on his stocks.
Well, thanks.
So,
Well, thanks for having me on.
Yeah. So, Ron, please tell our listeners where they can find your work more about Hera Research.
HeraResearch.com. It's HERA Research.com.
Okay, thanks, Ron, and hopefully we'll have you back on soon.
Thanks again.